All right, Bryce, well, we've covered off the news. I think it's now important to remind ourselves of the power of long-term investing. Why, at times like this, it pays to stay invested.
Yeah.
And I think there's 3 points we want to make here. First of all, the long-term performance of the stock market includes times like this. Secondly, is if you miss the recovery, you miss out. And then finally, picking the turnaround is near impossible. So let's start with that first point we want to emphasize. All of the long-term stock market performance, all of the history of the stock market includes times like this.
Yeah, well, we harp on about the All Ordinaries returning 13% a year for the last 100 years with dividends reinvested. And that's not just us cherry picking the best years and saying the average has been 30%. It's every single year that is included Great Depression, World War, trade wars, you name it, COVID. That return has included the wall of worry that we often talk about. And so
it's included prime ministers going missing off the coast. It's included not just COVID, but like the Spanish flu. It's technological disruption.
The Bombers not winning a flag in 20 years.
Like companies collapsing. Like everything that we're worried about, the market has overcome in that 124-year history that we always.
And I think that word there, overcome, is the most important thing that I constantly remind myself in times of this, because it always has recovered, and not only recovered, but it has always gone on to reach new highs.
And I think the stat that we were talking about earlier is if we go over to America, the S&P 500 falls 20% or more every 4 years.
Yeah, thereabouts.
I mean, if you look back on the last 7 years, this is the fourth fall in those 7 years. So that's even more frequent. 2018, 2020, 2022, and now 2025. So I think the first thing is this isn't out of the ordinary. Which leads us to the second point. What history tells us, if you miss the recovery, you miss out.
Yeah, this is also something that I remind myself, because this is what freaks me out the most. If you're trying to sell out and you miss the side on the way up, you are in a lot of trouble. A Bank of America study of the S&P 500 from 1930 to 2021 that shows that there is significant impact on your total returns if you miss just the best 10 days of each of those decades.
So let's look at some example decades to give you a sense. In the 1940s, you would have returned 35% if you just held. But if you'd missed the 10 best days, you would have lost 14%.
Wild.
Or in the 1990s, you would have returned 316%. But if you missed the 10 best days, you would have got 186%. So the Bank of America rolled that up and looked at from 1930 to the end of 2021. If you just held through that whole time, 17,715% return. Epic.
Wow.
If you'd missed the best 10 days of each of those decades, so what, 90 days across 9 decades, 28% return.
That is wild.
I know.
That is wild.
It is wild, and it's hard to get your head around. But
it is hard to get your head around.
It's because you get all of the worst days.
Yeah.
So you get all of the bad,
yeah.
But then you don't get that sharp recovery.
Yeah, yeah. So you almost get a double whammy in selling at a low point and missing the upside.
Yeah.
You're down on the way out, down on the way up.
But here's the thing, and here's why this is important. The very best days of the stock market often happen at the worst times. So this is research from Hartford Funds, and they looked at when those best days happen. 78% of the S&P 500's best days occur during a bear market, so after the market has already fallen more than 20%, or during the first 2 months of a bull market. So that's when the market is just starting its recovery. If we look back in the GFC, the S&P 500 bottomed on the 9th of March. Then all of the concern around a double dip recession and the economy going to collapse, it was up 30% by May. It was up 60% by the end of 2009. If you were waiting for that perfect moment to buy, you probably missed that sharp inflection up.
Yeah.
And I think that's really the second point that we want to emphasize, that if you miss the recovery, you miss out.
Well, Ren, just to illustrate that point, we've got a chart here that shows the various S&P 500 drawdowns and how the market reacted following the trough or the lowest point. So let's take the GFC. 2009 was the lowest point. 3 months later, the stock market was up 39%. 6 months later, 53%. 2 years later, it was back up almost 100%.
Yeah, and I think that sharp 3-month number is the one to illustrate.
Yeah.
COVID-19 in 2020, after 3 months after the trough, the market was back up 40% already. You can look at, the Great Depression. 3 months after the trough, the low point of the Great Depression, the market was up 93%.
Yeah.
If we go more recent, the 2018 when market fell 20%.
Yeah.
3 months after the bottom, it was up 19%. The European debt crisis, at the bottom, 3 months later, the market was up 11%.
Yeah.
You don't want to miss that sharp inflection up. That's really the second point. If you miss the recovery, you miss out on like a big chunk of your returns, as that Bank of America study told us, which really leads us to our third point.
Yes.
Picking the turnaround is near impossible.
Near impossible, and Ren, that's because the perfect time never looks like the perfect time. We're not sitting here being like, we're in the trenches right now, but you know what, this is the time. This is the bottom of the market. We've taken a look at 3 of the most recent market collapses, 2001, 2008, and 2020. And we've got some newspaper headlines from the perfect time to invest, which is the bottom of the market. Because what is clear is that it wasn't easy to tell that it was the bottom of the market. So if we look at 9th of October 2002, the Nasdaq is down 78%. This is the bottom of the market. The Wall Street Journal headline was, "Debt woes don't discriminate. Tech stocks close lower. Investors seek defensive positions." Nothing in there telling us, hey guys, this is the bottom of the market.
Yeah, if we fast forward to the GFC, 9th of March 2009 was the bottom. The S&P 500 was down more than 50%. The headlines from that day, Wall Street Journal, tech drop takes down stocks. Also the Wall Street Journal, China warns of severe fiscal conditions. And in the Financial Times, Obama urged to let the banks fail. No indication there that it was the time to get back in the market.
Yeah, well, I mean, even right now, yeah. I mean, looking at the headlines over the last couple of days, you wouldn't know. But in March, 20th of March, 2020, the S&P 500 was down 31%. It was the fastest fall in stock market history. It was the bottom of the market. The New York Times was saying a torrent of job losses threatens to overwhelm the US economy. Again, coronavirus layoff surge overwhelms unemployment officers. The Wall Street Journal, venture market shows sign of stalling, and the Financial Times, US to be swamped by jobless claims. Again, nothing in there that indicates this is the bottom of the market. It is near impossible to time the bottom of the market.
So let's put this together. You don't want to miss the recovery because they're some of the best days, and those best days can drive a lot of your total return. And picking when those best days are is almost impossible. So what's the answer for people like us who are just trying to build wealth over the long term? To our mind, there is only one answer, which is to stay invested. Because if you try and time the market and you miss out, that is going to be more detrimental to your wealth long term. The market historically has always recovered. This is, in hindsight, these moments have always looked like great buying opportunities.
Yeah.
So stay invested, stay the course, stick to your plan. And if you have the cash on the sideline, think about buying more.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.